Hello and welcome. You may have seen this topic on TikTok, on YouTube. It is all the rage, which is kind of funny because it's been around forever, but infinite banking. Yes, you may have heard this. If you haven't, it is a very unique and very powerful tool, but we need to make sure we understand it because it is not for everyone. Now, you'll see lofty claims on TikTok and YouTube stating that it can be X powerful and kind of build it up to be way more than it can be, but at the same time, it is a very, very powerful and useful tool if you are in the right set of circumstances. But before I get into all the circumstances and the complexity of everything, let's just get down to the basics of what banking means. Not even just the infinite part, let's just talk about banking. So the way money with banks work is you put your money in the bank, preferably in your savings account, let's say, and they give you about a 3% return. That'd be a really high yield savings account. But then what they are doing is taking your money and loaning it out to someone for, let's say, 7%, these days 9 to 10% interest. So they are pocketing the difference between the 3% they're paying you on your money and the 7 to sometimes 10 or more percent they're making from loaning it out. They pocket all that difference. Now, what if you can be your own bank? What if you can deposit for yourself that is gaining interest? Then you can take that loan against yourself to invest in other things. So you have your basis that's compounding interest in this place where you've stored your cash away. And then you can also take that out as in the form of a loan while that money sits there and keeps compounding and put that into external investments or large purchases you might need. That is the foundation of infinite banking, taking what the bank does with hedging those rates and pocketing the difference and bringing the money to you. Why is this powerful? This is powerful because the bank isn't just pocketing, let's say they're earning 7%, right? They are not just pocketing 4% returns on that money. If that is all they were making, they should just invest in the stock market. What they are really pocketing the difference on is the difference between what they're paying you. So instead of perceiving it as a 7% return for the bank, think of the difference between your returns, which is 4% positive for them, over the return that they're giving you. So it's really more like 133% net benefit for the bank for every single dollar you put in that they can loan out at 7%. Can you imagine having a guaranteed 133% gain per dollar each year? That is how banks are able to, I wouldn't say take advantage of us, but perform really good business and be stable for so long. But how can we be our own bank? What is infinite banking? How does it work? I've already kind of touched base on kind of the core concept of it, which is bringing that banking functionality to us. But for a true overview of exactly how infinite banking works, what we are doing here is we are taking a life insurance policy, which might sound a little funky. How can life insurance be my investment? I thought you just get paid out when you die. No, there's actually a lot of complexity to that. And what we're using is a whole life insurance. So this is not just a term, life insurance, this is a whole life. So it's a different type of mechanism that we are able to use as it grows value and cash. So technically, if you were just to make your normal policy payments, the net death benefit, net benefit from the policy would grow over time. But what we are purposefully doing is overfunding it. This creates a net surplus for us that is now our money in a tax-advantaged account and earns at the dividend rate of that insurance firm. These different insurance firms offer different dividend rates. This is essentially the equivalent of the money getting put in the bank and you getting your high yield savings account. Except instead of 3%, this is compounding at anywhere between 5.5 to 6.5% as of right now. These do change over time. In the early 2000s, they were 9%-ish on average. And so they do fluctuate and they have gone down a little bit in the past 20 years. So it's important to pay attention to the rates to understand what vehicle makes the most sense for you. Because as the S&P 500 has gained an average of about 9.5 to 10% each and every year. Now, as you continue making payments or overfunding your whole life insurance policy, which you can do this in large lump sums, you can start by just throwing in thousands of dollars. In fact, one of the ways that I was initially able to get started is throwing in $10,000 and then making my overfunded payments after that. What you do is you slowly keep building up the cash value of that overfunding on top of the benefits that are compounding. What do you get out of this? The overfunding goes towards cash in your account that is earning interest at a higher rate than a high yield savings account by almost double the national average, a little over. And you also get life insurance. Most of us have to pay for that anyways. Some of us, we just get the one that comes with our employer, but there are a lot of options out there, and typically the life insurance policy you're getting with your employer doesn't have a lot of the benefits that everyone should really have today. Did you know life insurance doesn't just need to pay you out when you die? One of the biggest problems I have with the majority of policies that are out there today is most of us are stuck with life insurance that we'll never get to see be used. Now, obviously, all the terms and conditions around life insurance, we don't want to see it be used. It will inevitably. But what if this insurance could work better for you? Ask your employer and inquire about living life benefits. Living insurance benefits are very important in life insurance because you don't just get a lump sum tax-free to your family when you die, but if you get diagnosed or a certain set of conditions happen in your life while you are still living, you can get a payout from your policy before you die to help you when you need money the most. If you get diagnosed with cancer, or you have a major disability, is that not when we need money the most in our life? And that is also when we have the least capability to make money, to pay for when we need money the most. Make sure you have the right life insurance policy to make sure you can get large payouts to help you in the event of chronic illness or a horrible, life-changing new condition. If you want more on living benefits and how these accounts work, please be sure to like and subscribe. This is definitely a video I want to make in the future, but I wanted to touch base on infinite banking first just because I've seen a lot of misinformation on this. The key to infinite banking, bringing it back, is the fact that we can borrow against it. Now, this borrowing is not free. We do have to pay an interest rate on it. The thing is, though, is this interest rate is typically about the same, if not a little bit lower than the interest we're compounding at. So it's almost like you are borrowing the money for free. And with a lot of accounts, you can borrow this money while your initial cash investment into overfunding your whole life insurance still compounds at the current rate. Please be sure to check up with your terms and conditions though, because sometimes this can go to half rate for each dollar that you borrow against the whole life insurance account. So please be sure you are up to date and have the right policy for you and borrowing accordingly. What this does is we can borrow, our cash keeps compounding, and ultimately what we should be doing is using that money towards something that would net a greater return to exceed what we would have otherwise made with just throwing it in the stock market. This provides a little bit more stability as infinite banking, overfunding your whole life insurance dividends tends to be a lot more stable long-term than the stock market. While the stock market has a larger average return of almost 10% instead of the current average of about 6% with infinite banking, you do have down years. In fact, with the stock market, you had '08, you had 2000, you had the early 1990s, you had 1987. There are a lot of crashes in US history where if you drop 50% on your portfolio, you now need to double that to get back to your base. You now need 100% gain to get to your base. With infinite banking, you don't drop down your portfolio. The worst thing that can happen is you just earn a smaller dividend for a year. Dividends can also go back up. It's all just subject to policies and regulation changes. With this, you will always be paying a premium, as this will be going towards your life insurance. So we do have to pay for our life insurance. And then also we are purposely overpaying on our premium to continue building up that cash alongside the dividend. And then if you borrow, you will be repaying yourself on that loan on top of the premiums you are paying. Now, what is really cool with whole life policy is that you have guaranteed cash value. The cash value of your death benefit, your living benefits is all mapped out very, very discreetly on the plan you create with your advisor, on the plan you create with your agent. You can see exactly how that cash value is going to grow, how much you will be able to borrow, and also what your death and living benefits will be each year. As you update your premiums and your policy, you can get those new and updated numbers. This cash value grows at a near guaranteed rate, receiving dividends yearly. And these dividends compound, which then you can then use as a very tax-advantaged way to have a stable income when you eventually retire or whatever you need. And when you take out your policy loans, these are collateralized by your cash value that you overfunded your whole life insurance account with. Meaning that you essentially can take up to the value of how much you put in, roughly. For your first few years, it's going to be like 80% of that. So if you put in $50,000, you could borrow $40,000 of that to use for external investments or purchases. So let's break down the process and streamline it. You pay your premiums, overfunding the account. Sometimes starting with an initial lump sum to just go ahead and build up something you could go ahead and pull for an external investment as well. Continue building that cash value. You keep overfunding this. It can be $600 a month, $1,000 a month, whatever it is. You're kind of treating it like a savings account. Then you borrow this, hopefully using it, like I said, for advantageous investments that would overall increase your overall performance above the average return of the S&P 500. As we are borrowing, we must repay those loans. What are our benefits here? You get improved liquidity. You can always borrow from yourself and you still have that money compounding, assuming your rates don't drop, that money isn't frozen for each dollar borrowed. Really, really make sure that wherever you're getting this policy is not screwing you over in that department. But you're able to access that cash for external investments, emergency purchases, whatever you need. You just need to pay yourself back eventually. They are low rates for those loans compared to what you would get out of a bank. You get more control. You are financing your own purchases with your own money without having to take from what you put in the savings. Savings being the amount of money you've filled up and overfunded your whole life insurance with. Tax advantages. This cash value grows tax deferred. And then the loans are tax free. So when you pull $40K in the form of a loan, you're able to use that and not have to pay taxes on that, and then you pay yourself back. Now, the overfunded whole life is compounding interest annually, and that is all tax deferred. So you will pay taxes later when you pull. So as you shift things around within the account, no taxes, but as soon as you're starting to pull, you pull at your tax rate for your expenses then. Be careful, because if you expect your expenses to grow as you get older, you will be in a higher tax bracket, which means that this could actually get taxed higher than you are getting taxed today. The near guaranteed growth and potential dividends from the insurer. You cannot go down. It can only go up. You only get dividends. This is not subject to the stock market going down and up like crazy, valuations going positive 20% and down 50% the next year. There will always be a dividend. That dividend can just simply change, and it has gone down about 33% since the early 2000s. That is due to very drastically different conditions, though, within banks, and have since stabilized at around that 5.5 to 6.5%. And then one thing I don't have listed here as a benefit, but is important to call out, is these loans oftentimes that you borrow against each other, and you can double check this, are not counted in your credit report and are not able to be seen by the bank. So if you do need to take out a credit card, take out an official loan with the bank on top of what you are loaning yourself, which that is a lot of leverage, I would advise against it unless you have very, very concrete plans with it. But you are able to double dip in that aspect. So how does the math play out? Borrowing and compounding returns here. So as you borrow, your cash value remains and it keeps gaining its dividend at around a 6% return, right? And if we borrow at 5%, our net consistent gain is 1% in that account. Mind you, it is still compounding at 6%, just we're having to pay back at a loss on that loan of 5%. So our net gain overall is 1% there. Now, if we took that $40K out and put that into an external investment that made 10%, our net overall gain across all the transactions over that period, let's say a year, it's 11%. We just beat the stock market, and 6% of that is tax advantage with our tax deferred strategy. Not to mention, this whole time, your death benefit and life and living benefits have grown. Now let's look at this as we put our money aside, borrowed against ourselves, didn't put it in an investment. What does that look like? Well, you get your 1% spread with the policy loan versus the dividend, and that's simply it. You burn a lot of the value you would have gained that year paying yourself back, but your initial cash value does still compound at that 6%. You're just eating the loss on the 5% you're having to pay yourself back. If you are able to get in and out of that investment quicker, with a return of 10%. You're not paying a 5% interest rate anymore. You might be able to get in and out before you pay too much interest at all. There's just a lot of compounding opportunity though, where we can take out our money and put it into another, like your business or real estate or different investments that can compound and have this savings account that you're financing your own ventures through instead of just putting it straight towards the venture. Now, what's the scary thing? If we put this in an investment, we took our policy loan and put it into an investment. If we lose money, we still have to pay back the loan. So you did leverage and you do have to still pay back that loan, which means you could be eating a pretty large loss. So if you took all this money out, threw it all in the stock market, trying to double dip, earn an extra 1% edge on the stock market for the year, that could come back to bite you if we had a rough year in the stock market. Now, what are some of the risks and downsides? So I don't have it here just yet, but initial risk and downside is if you are not going to diligently use this towards real estate, business, other investment opportunities, your rate of return is not higher over the long run than the S&P 500. So if you have 20 to 40 years that you're stashing your money away, if you're younger, you have more runway, but you don't want to start your own business. Let's say you just want to work at your job, build up, your portfolio over time and just rely on that. I'd encourage probably looking a different route at least, or maybe diversifying some into this portfolio, knowing that you can have that, potential quick money to loan out in case of emergency, but knowing that the real moneymaker for you is probably going to be sitting on the market as you'll get closer to a 10% rate, which doubles every 10 years versus I think with 6% is closer to every 13 years. Now, if you do have a shorter time frame and you need something more stable, you have a lot of cash, this is probably a really good investment for you. If you're in your 50s, 60s, assuming you qualify for the insurance, I would highly consider this approach as this is a lot more stable income that you can borrow against. And that is tax advantaged as well. Now, what are the risks and downsides? You're going to have a high premium requirement. Your whole life insurances tend to cost more than term policies. And on top of that, you are overfunding. So you're purposefully paying a lot more than the regular insurance costs. There is a bit of a slow buildup. The cash value could take, if you are not funding it pretty aggressively, it could take up to a decade to accumulate to a meaningful amount. If you're able to fund it, let's say $50,000 right away, you're a little bit later, you have a larger savings, and that's a different story. That is more about like a year or two. So you do have a slow buildup if you are starting at nothing and just paying your regular premium payments that are overfunding it. So if you're starting younger, it takes longer, but it is very tax advantaged. It could help you in the long run. But if you have a lump sum, especially a larger lump sum to throw in initially, that does negate a lot of the slow buildup effect there. Then overfunding takes a lot of discipline. You will have to pay about 10% of your income and be very committed if considering the average person. It is pretty much becoming your savings, honestly, for where your cash flow is going. Then the complexity of all of this. Now, the initial aspect of just build up using the 6% dividends, that is not complex. What is complex is borrowing against yourself without hurting yourself financially. You need to be really careful with your investments to make sure you don't eat a large loss because you're not able to repay your loan back. Also, there is some very careful policy design that you need to work with. Make sure you're going with the right insurer for your life insurance. Make sure that they don't have any weird policy fine print that go against you and hurt you for borrowing or lower than average dividends. And then a lot of this depends on your own stability in the long run, as well as dividend performance. If the dividend continues to drop and drop significantly, then you will need a higher external return from your investments to make up for the fact that stock market just keeps returning an average of almost 10%. And also you are relying on the insurer. Hopefully you're going with a large enough one that is stable and will be here for the long run. So what are our requirements for success here? Financial discipline. I mentioned this earlier. You are going to have to make consistent high payments of about 10% likely of your net income using the average income of the US, and you need to repay your loans. You can't just let those sit and accumulate interest because So then you're negating the whole point of overfunding your whole life. Choosing the right policy, you need to work diligently with your agent, make sure that things are in your favor, make sure you're getting closer to the 6.5% dividend and that they have any guarantees for a higher dividend in the long run, as well as making sure that when you borrow against yourself that they don't cut the dividend for each dollar you borrow, items like that, as well as making sure you have living benefits. That way, if you get diagnosed with cancer or any other horrible illness, that you can still have money and pay for life while you're still living and not just have to rely on the death benefit. And then also working with your agent and doing your own homework to understand the fees and the loan terms, making sure you don't have any surprises when, life happens, things happen, and it's always better to ask questions and know more than to just be ignorant, especially when you're dealing with a complex and very powerful tool. And then this needs to be a long-term commitment. Your success depends on decades of compounding, making regular premium payments, as well as using those loans for, strong investments. Here's a case study that I don't love, but it is helpful to see where, in my opinion, you should be taking out a loan when it is advantageous to you. Ideally, an investment that will return at or more than the stock market. But here we have an example where you use a policy loan versus a bank loan to fund getting a $20,000 car. Now, this does imply that you have $20,000 or more in your whole life insurance already overfunded. But what we can see here is if you borrow $20,000 against your whole life, that you have to pay yourself back that $20,000. But the whole time, your whole life is still growing in that dividend. So you might be paying 4% on the loan, but you're making 5% on your dividend. So your account is still growing and you borrowed against yourself. Whereas, what if we take the loan with the bank? You now have $20,000 in debt. You're probably paying 9 to 10% and you pay them till it's zero. Nothing grows except what the bank gets. So for a quick summary and takeaways, infinite banking can provide a really good way, especially if you're disciplined, to build strong savings and liquidity with your money where it still grows at a guaranteed rate better than a savings account, but gives you liquidity to be able to take and get buying power from that without taking from that account. And then you get more control over your financing as you are the one lending money to yourself. You will be paying a lot in premiums, and it does require patience as you, without putting in a large lump sum, it does take quite a bit of time for that account to build up. These accounts are tax advantaged, meaning that when you take the loan out, it is not taxed and all your taxes are deferred. Make sure you evaluate the alternatives, both different insurance types and policies, different investment opportunities, as well as within whole life, the different routes you can go for different higher dividends, better policies that better suit your interests. And really, I recommend sitting down with an agent that you know and trust and seeking their expert guidance before committing. This is a very big decision in everyone's life. Finances are extremely important, so please sit down with a professional and get to know a lot more than just what I covered in today's topic. And wanted to leave this last bullet point here. This is best suited for individuals who have a stable income that want control and value long-term planning. The younger you are when you get into this, the more powerful this tool becomes. I'd like to add one more caveat and use this for stable investments. If you are able to take these loans out, you value control, and on top of your stable income are putting this into stable, good investments that overall add up to return near or greater than the stock market, you're getting a lot more value out of this than just throwing this into the stock market, as these returns will be a lot more stable and long-term guaranteed than the ups and downs and crazy swings of the stock market. But that's all I have for today. If you like this content and would like to see more videos like this, teaching you about different strategies, where you can put your money, different tools you can use to better your life, please be sure to like and subscribe and share this with your friends and family. There's a lot of misinformation about infinite banking out there. In fact, some of my own family kind of got swindled into some things without talking to me first. So please share this video, make sure everyone's informed, and it'll only make everyone's life better because of it. Last thing before I leave off, talk with a financial professional before committing to anything. Thank you. See you next time.